Global Income Builder Fund. Giorgio, the average Bloomberg economist survey, it's like 60 respondents. They, about a week ago, had their year-end estimate for the 10-year to be at 1.35. It's since moved up to 1.45. Should it be moving up more?
Yeah, it's a great question, Oliver. I remember it was back in late October that you and I were talking about how it is probably time for income investors to start thinking outside the bond. And
yes,
back then the 10-year was actually in the neighborhood of about 85 basis points, right? And since then, we've had very positive news in vaccines. We've had a Democratic pro-stimulus president. We had a Democratic pro-stimulus Congress, right? And the 10-year's up 40 basis points. But by some metrics, you could say that it's amazing that it's actually only up 40 basis points, right? You've got a stimulus plan in the pipeline. Cases are coming down. Vaccines seem to be effective. And so certainly the risk does remain to the upside in terms of yields. Behind this stimulus plan is the possibility for, $3 trillion plus in terms of infrastructure. And so, really, if you're an income investor and you've been leaning on investment grade for income, you really need to start thinking about the downside risk that you could have. And so far spreads have largely absorbed the rate move, right? Mm-hmm. And so you're only just starting to lose money, right? Investment grade is down this year, down about 2.5%. But you're at the point where spreads will no longer cushion you because we're starting to get closer to the all-time tights. And so, with the risk being to the upside in our view in rates, you could see some significant losses, and really it's not too late to reposition.
Giorgio, to your point about how with everything happening on the stimulus side, and then also the overall recovery taking shape, that you could very well make an argument that yields could be even higher, kind of speaks to the idea that the market has faith that the Fed is not going to hike rates. But that's very much a magnitude story, right? In terms of rate of change and direction being also important. Are investors, do you think, overconfident or misunderstanding the Fed's role in controlling the long end of the curve? I mean, it's pretty far away from where they're directly involved, and it seems like the long end is moving, baby. And the Fed is just talking more and more about not cutting. So, not hiking. So it doesn't seem like there's much of a correlation between the Fed's language and the long end right now, Giorgio.
So it's interesting because we saw real rates start to move up for the first time since the Georgia runoff, right? And back then we did see a bunch of Fed speakers come in and start talking about how tapering wasn't going to happen anytime soon. And we're starting to get back to those levels again in terms of real rates, right? So rates adjusted for inflation expectations. And so far, we're listening very closely. We haven't heard anything. You've heard Daly talk about how there's very little risk of inflation. I think it may have been Brainerd today who was talking about the environment. So you're not seeing the same reaction. You're not seeing the same response out of the Fed yet, right? And so, if anything, in the minutes, in some of the other commentary, you're just seeing very strong commitment to keeping the front end anchored at low rates, staying with status quo. And really, until we see anything, any reaction function out of the Fed, certainly the trend is for the long end to go higher, right? And that's just something that, don't panic about it, but you can start to position to protect yourself if that were to kind of pick up steam.
Let's talk about how to protect yourself overall, Giorgio. This past week, as equities rose, bond yields were going higher, and then as equities dropped, bond yields still went higher, just at a slower pace. As today we got a little bit of a bid coming into the bond market, but not much, and it really took like 1.5% drop to wake people up to buy bonds. So should we expect bonds to do less protecting for an equity portfolio? I mean, I know this is kind of what you've talked about before. So if it's not bonds, then what else? What works? I mean, do you just need to have a bunch of cyclical rate-sensitive stocks to hedge yourself if you're equity allocated?
So that's where we're heading, right? So we manage a flexible strategy that invests in fixed income and equities, and we're leaning very heavily on equities for income today. And even within equities, we're probably 70-30 skewed towards cyclical equity income and away from defensive equity income. And even within our defensives, we're skewing away from things like utilities that don't have pricing power and more to kind of better defensives like pharmaceuticals and consumer staples companies where they do have some pricing power. And that's the beauty of being able to flex out of fixed income. You know, bonds don't care why rates are going up. You know, it's any rate increase is bad, but you know, by branching out into equity income, you know, you can find spread businesses which frankly, you know, they don't care why rates are going up. It's all good, and you can also position for managing inflation through you know, through industrial cyclicals and some of the materials businesses that you were talking about earlier. So the upshot is that there are tools at our disposal. We don't just have to sit in long duration investment grade and lose money for the next 2 years, but we do have to be flexible and try and get ahead of what could be ahead of us.